My friends, what is good? It's now episode 2 of Clueless2Confident, and this is where trading gets nice and juicy. Today we're going to go over what technical analysis is, and I'm also going to give an introduction to what Japanese candlesticks are, so you have a clear understanding on those. But if you're new to this channel, hit that subscribe button so you don't miss any future content, and also remember to hit that like button as well. That's a nice way for you to return the favour of me helping you. But if you've ever seen traders' charts before and wondered what the hell is that on their screens, it looks like something off the Matrix. How the hell do they just choose what they're buying and selling? I want to know what all those lines on the chart mean. Well, today's your lucky day because that's exactly what we're going to go through. So let's roll that intro.
She wanna know me, I don't really wanna know her. She really wanna phone me, I really wanna throw up. I ain't into this fake shit, dripping when I make it. Sipping, I be faded, my flavor be tasting amazing. She wanna know me.
Guys. So this here is an example of what technical analysis will look like. But the first thing I'm going to do is take these silly little indicators off my screen because I want you guys to completely refrain from using these when you're starting off. You may have seen them before. They're very commonly relied on by especially new traders, and that's why I've put them on there, but they've got to go. I personally don't use them at all. I know there are strategies out there that will have indicators built in, and they are profitable, but as for myself, they're not something I use at all, because to me, especially, they make no sense whatsoever. This one here down at the bottom is called the RSI. Now, this is the Relative Strength Index, is what it stands for. It essentially shows you when the market is overbought, like up here, and then when we see the drop, it'll then tell us when it's oversold. But if you look here, for example, straight away it says it's oversold. And if we line that up, that's with this point here. Now, as soon as it tells us that it's oversold down here, it then goes on to have nearly a 300 pip drop in price. So that's as to why I don't really use them. So let's just say goodbye to you silly little mugs. RSI going. This one here is the moving average. This will essentially tell you the average movements within the price. It will, pretty much always come back to it wherever it's above or below. Traders will use these in strategies where when you see a candle close above on the moving average to buy, vice versa when it's below, when you see a close on the moving average, they'll then sell. But yeah, let's get rid of you. Not something I use at all. But anyway, here we're looking at NJ, which is New Zealand dollar against the Japanese yen. Now, I completely understand that when you're brand new to trading, you see something like this, you're going to find it quite daunting, which is normal because it looks like there's a lot going on at once. But the only thing really going on, if you will, is the change in price. Now, all technical analysis is using different types of levels on the charts to break down price action so we can understand what price is probably going to do next. But notice how I said probably. Like, no one knows for certain what price is going to do next. Ever. Not one person. Of course, specific people will have certain influences on the markets, but they don't even know what's going to happen for certain next because, the market is literally controlled by an abundance of factors, and everyone has a small influence on the direction of price to some small extent. So I said probably because it really is just a calculated game of probabilities, and we as traders use historic data on the left side of the charts to determine the most likely potential outcomes that then occur on the right side of the charts. So kicking things off, when you first bring up your charts on TradingView, you're going to have your selected currency pair, as I said, and then you're going to need to select the time frame that you're analyzing. I myself am on the 1 day time frame. So this means every single candlestick we're looking at represents 1 day, as you can see on the horizontal grid. But if you're not too familiar with charts, on the right side, the vertical column, as I move the grid down, you can see the right represents the price. And on the horizontal side, you'll see it will give me the date. The horizontal column at the bottom here will give me the date. So you can see as I'm moving it from left to right, the date's changing, which means if I go into a smaller time frame, you'll see that here now, every candlestick then represents 15 minutes of price. So if you look onto the horizontal column on the chart, every time I move my cursor across, there's a time change in 15 minutes. So every candlestick here now then represents 15 minutes of price. But when we're looking at price, Here, as I explained on the vertical column, this represents the exchange rate for the currencies, and you'll hear a lot of traders talk about the number of pips they caught on their trade, but to keep it simple, all a pip is are the last numbers on the end of the exchange rate. So on most currency pairs, you'll have a number, and then a decimal point, like so on the Euro Swiss, a number, then a decimal point, and then you'll have 4 numbers, and the number on the end will represent the pip. So the 8 here in this circumstance will represent the pip. However, most brokers will show 5 units after the decimal point. And the one on the end, the small one here, is known as a point or a pipette. Now, 10 points make 1 pip, same way 10 pipettes make 1 pip. It's all the same. It's just a term used to measure the change in price. So essentially in Forex, a point and a pipette are the same value, but keep to using pips to measure and change in price because it makes life a lot easier, trust me. A little bit different though in Japanese yen pairs, however, same principle. It's not 1 unit, then a decimal, then 4. A little bit different. The 4 here would represent the pip, and the small one being the point or the pipette. But yeah, I mean, pips are pretty easy. If you're struggling with pips at all, if you come on to TradingView, you can take the price range tool here. You can take a high against a low, measure that out, 32.3 pips, it'll tell you there at the bottom. Take the high, 70.419 against 70.96. That's a 32.3 pip move. So yeah, following on from pips, I'm going to give an introduction as to how Japanese candlesticks operate and how they represent price change within one time frame. So firstly, let's look at what you're probably used to seeing when you go onto Google and check your exchange rates or wherever you're looking at for your Forex rates for your trips abroad or what have you. This is probably what you're used to seeing, just a bog standard line chart. But let's forget this amateur looking chart and let's take it to the next level. Let's have a look at the bar chart. So this is a lot more exposing. You can see the opening price and you can see the closing price. Now, just to explain how these operate, because they're very, very similar to Japanese candlesticks. On the left, you'll have the opening price. You'll then have the high, the low, and the close. And they're really telling a story. Open, low, high, close. Open, high, low, close. Open, high, low, close. You get the point. You see what's going on here. Yeah? Quite self-explanatory, right? Japanese candlesticks are the exact same. So let's have a look at them. So let's go from the bars to the candles. Now look at that. Let's just compare them. There's hardly any difference whatsoever. Same principle. So we'll go from here. We've got the opening price, the high just above, the low, the close. The opening price, the high, the low, the close. Yeah? Opening price, high, low, close. Let's come over here with a more volatile. Opening price, high, low, close. Opening price, low, high, close. The order slightly changes when the candle changes colour. Now this goes from red to green because obviously the closing price of the next candle is higher than the previous closing price of the previous candle. That's all that defines the change in the colours. So that's exactly why we use Japanese candlesticks. They're just very exposing of what price is actually done within one time frame. So now that you know how Japanese candlesticks work, we're going to come on to the daily time frame again, and I'm going to show you a couple of examples of candlesticks and how we can read candlesticks to understand what's happened within price within a certain time. So with all the crap that's online with what certain candlesticks mean, there are only a few different types of Japanese candlesticks closures that I personally use as part of my arsenal. Now, to be honest, there's no one major element in technical analysis that is more important than anything else. Being an analyst of the market is all about what you're able to see on the charts and how you're able to capitalize on being able to reprice. It's all about using confluences within different time frames to paint one big picture and understand the market cycle. But I would never just look at a candle and say, right, yeah, that's it, it's going up. That's stupid. You should use a candlestick closure as confirmation with other factors to, as I said, paint that big picture. So firstly, we have a doji. Now a doji is just when a candlestick opening and closing price are more or less the same. So it would look something like this. So I've just zoomed in. This is what a doji would look like. I guess you could say they're both essentially dojis because the opening price and closing price are more or less the same. Now, typically it should look like a cross, like so. Within this time period, there's either been an exhaustion in momentum, which can mean there's been a lot of traders taking the opposite side of the market. Now, if someone is on the opposite side of the market to you, this just means their bias is different. So if you're holding the trade anticipating the market to go up, they're holding the trade anticipating the market to fall. So they might have a bearish outlook when you have a bullish outlook. Bullish is just a term for an upside view, and bearish is just a term for a downside view. Some people may say doji means there's been indecision from traders, which I guess would make sense when just coming out of a consolidation region like so. But there's always a lot more going on than just that, I can assure you. So moving on from dojis, we're going to have a look at hammer candlesticks. Bang. So that's the bullish hammer candlesticks drawn out there for you. All a hammer candlestick is essentially where we've seen price come down, test the lower levels, fail, leave a wick, and then come up and close. So it almost looks like a hammer. And that's exactly why then the candlestick looks the way it does. We can see the exact same over here. However, it's come down, it's tested the lower levels, it's failed, but then we've seen the push down and move down there anyway. And that's an example as to exactly why you should never just use candlesticks on their own. Now, a bearish hammer candlestick is literally the opposite, but it's the exact same concept. I've drawn 4 out on the charts here. 1, 2, 3, 4. Now, you might hear some traders say, oh, well, it can't be a bearish candlestick if it closes green, but you've just got to be smarter than a colour in this industry. If anything, they want you to think like that. If you look at each individual candlestick, you can see on every occasion, we've pushed up, tested the higher levels, come down and failed, and then we've had the fall. Same again here, same again here, same again here, but there will be more bearish candlesticks that didn't actually provide any sort of drop after the closure of the candlestick. But that's absolutely fine because nothing has a 100% hit rate in the market. So then next on we have the bullish engulfing, which I'm going to bring up now. So again, I've circled these in green. All a bullish engulfing candle is when a bullish candle, which is a green candle, engulfs the previous bearish candle, which is a red candle. Now, what we can understand when looking at a bullish engulfing candle is that there's been a higher activity of buying which has taken place in this area. And that suggests to us that the number of sellers in this previous candle has been outnumbered by the buyers at this point. So here, for example, we've seen a little bit of an uptrend and then a bit of consolidation. We've then seen a bullish engulfing candle, which suggests that the market's going to continue its uptrend. And that's exactly what we've seen. And we've seen that here. We've seen a rise, bit of consolidation, bullish engulfing candle, and a rise. And then we've seen a pullback, bullish engulfing candle, and another rise. So that's what we can understand when looking at bullish engulfing candles. Now, as for bearish engulfing candles, I'm now going to circle these in green, like so. Now again, the exact same as the bullish engulfings. We can see here, we've been in a downtrend, we've then had a bearish engulfing, and then we've seen that continuation to the downside. Bit of a pullback then, again, another bearish engulfing, before we then continue to make a new low. Coming over here to this bearish engulfing, again we see the bearish candle engulfing the previous green candle, which then provides a very impulsive drop then to the downside, and so on. It's the same concept, opposite approach. Now, I'll say it again. Use these candlestick closures as a confluence with other factors. Never just take one trade based solely off a candlestick closure. It doesn't make any sense. They should be used with other factors such as levels we use in technical analysis, as you may be able to see on my charts. But there aren't many types of technical analysis that I use. All I really use is support and resistance, trend lines and Fibonacci as a sidekick to my own personal method and concept on the market, which only I know and I've not shared with anyone. But in terms of this video, that's exactly what technical analysis is. So I hope you've taken something away from this video. Things are going to start getting a lot more technical now going on from this video. As I said, I will do a dedicated video for each element of technical analysis. So if you did enjoy, please press that like button and subscribe to this channel so you don't miss any future content. If you have any questions, as always, you can ask me down below and I'll be happy to help you out. Drop me a follow on Instagram also. I'm on there as a Third Eye Trader, same as I am on YouTube. But as always, guys, look after yourselves and I'll catch you in the next episode of Clueless2Confident.